Today, I'm sharing why dividend growth is one of the most important factors for long-term dividend investors. I'll illustrate this by modeling out how growth compares between three different types of stocks: a low yield with high growth, an average yield with average growth, and a high yield with low growth. Although with the lower yielding stocks, the dividends may start small, the annual payments will eventually dwarf that of the lower growth options. In fact, you'll actually make more total dividends, not even accounting for the likely much higher capital gains as well. Let's break it down. My name is Zach, this is Dividend Data, and you should leave a like and subscribe to the channel if you enjoy the video. Please sign up for our free email newsletter so you can get these videos plus a bunch of other great dividend investing content straight to your inbox. For example, the main idea of this video was already put out as a newsletter first. Links in the description and pinned comment. First, let's define dividend growth. Dividend growth refers to the rate at which a company increases its dividend payouts over time. Factors impacting the dividend growth rate will be the earnings growth, the company's cash flow, and the payout ratio of their current dividend. Typically, a dividend growth stock will raise their payment on an annual basis. Examples of this include the Dividend Aristocrats, which have done it for 25 plus consecutive years, and the Dividend Kings, which have 50 plus years of consecutive dividend growth. For long-term investors, this growth can dramatically enhance the value of an initial investment, especially when compounded over decades. To illustrate this, I created a simple model that tracks how a $1,000 investment would grow over 30 years across three different types of stocks. I'll be using Visa as the example of a low yield, high growth company, Procter & Gamble as an example of an average yield and average growth, and Verizon as an example of a high yield and low growth company. Let's start with Visa, ticker symbol V. The current stock price is $274.44 per share with a $2.08 annual dividend payment, making the current dividend yield 0.78%. This payment is very sustainable at around a 20% payout ratio. If you follow the channel, then you know I've done a full stock analysis on Visa in the past, and it's actually one of the top stocks in my long-term dividend growth stock portfolio. And the reason is that they have a fantastic business model with growing earnings and free cash flow. And that scalable, high-margin business model allows a lot of cash to be paid back to shareholders. And that comes in via a growing dividend payment and large share repurchases. But today we're going to focus on the dividend. The Visa dividend has been growing at a 5-year compound annual growth rate of 15.77%. The most recent dividend increase was 15.56%, and they're about to announce another increase before the end of the year. The increase before that was 20%. And this is actually matching the growth rate of their free cash flow per share, and their payout ratio stays in this extremely low 20% range. And I think these conditions are likely to continue, so we can assume moving forward that this 15% growth is reliable. So if you spent $1,000 today on Visa stock, then you would be able to acquire 3.74 shares of the company. And with the current $2.08 annual dividend, you would be getting $7.78 in an annual dividend payout. Now that seems like very little, that's because it is. However, when you project out 15% growth year after year after year, the numbers start to get very impressive. By year 10, you have a 2.91% yield on cost, and you're getting $29 in annual dividends. By year 20, you have a 12.56% dividend yield on cost, and you're getting $125 in annual dividends. And by year 30, you're getting a 54.34% dividend yield on cost and $540 in annual dividend payments. That means you're doubling your initial investment in Visa every 2 years from dividends alone. And again, this is not counting for any capital gains in this time, which I imagine would be pretty large if they consistently grew at 15% year after year. And in total, this would sum to $3,900 in total dividends. The second stock we have is the Procter & Gamble company, ticker symbol PG. This is a dividend king, and the current stock price is $169.17 per share with a $4.03 annual dividend per share. That puts the current dividend yield at 2.38%. And for a mature company, this dividend is sustainable at around a 55 to 60% payout ratio. The 5-year compound annual growth rate of the dividend is 6.18%. The most recent increase is 6.99%, although the prior dividend increase was 3%. If you had $1,000 and invested it into Procter & Gamble stock today, you would get 5.91 shares. And in your first year, you would be getting $23.82 in annual dividends. Now, if we go back to Visa, this is much larger than their first year. And by year 10 from the dividend growth, you have a 4.09% initial dividend yield on cost. This is $40.86 in annual dividends, and that is still higher than Visa in year 10. However, by year 14, Visa stock actually surpasses the Procter & Gamble stock based on annual dividends. And given the higher growth rate, this only gets much larger over time. By year 30, Procter & Gamble would be generating generating $135.56 in annual dividends, which is a 13.56% dividend yield on cost. Again, we're comparing that to 54.34%. So an incredible gap in dividend yield on cost and total dividends earned. And the ironic part is that I actually think that 15% dividend growth for Visa is more reliable than 6% dividend growth for Procter & Gamble. Finally, let's look at our high yield, low growth example, which is going to be Verizon, ticker symbol VZ. This is the famous telecom company, which is a reliable dividend payer. The current stock price is $41.21 with a $2.66 annual dividend payment, making the current dividend yield 6.45%. And the payout ratio based on free cash flow is 58% and 95% based on net income. However, historically, it has always been in a sustainable range. That said, growth is extremely slow in the telecom industry, and especially with Verizon. The 5-year compound annual growth rate of the dividend is 1.99%. The most recent increase was 1.92%. And if you invested $1,000 into Verizon today, you would get 24.26 shares of the company. And at that 6.45% dividend yield, you'd be getting around $65 a year in dividends, which again, this is much, much more than Visa. It is actually not until year 18 that Visa surpasses Verizon in annual dividends. During that year, Verizon has $90.21 in annual dividends, while Visa has $93.77. But by year 30, Verizon actually has the lowest dividend yield on cost of the bunch, despite having the highest starting dividend yield. It ends year 30 with an 11.43% dividend yield on cost and $114.27 in annual dividends. However, they do have the second highest total in total dividends at $2,613. However, that is still significantly below the Visa total. And there's a couple of takeaways we can have here, both from an intellectual investing sense and then from a personal finance sense. On the personal side, you have to factor in what your investing goals are and how long you're realistically going to live as well. You might need those dividends now if you're planning to retire and live off that dividend income right away. However, if you're young and have a long investing time horizon, like myself, then you should be more oriented to high growth companies. That is, if you can accurately determine which will be the reliable high growth companies. And another big factor here is that this model did not account for dividend reinvestment. And if you know this channel, that is a big part of a dividend investing based strategy. We call that the dividend snowball effect. And I actually built an entire calculator available for free at dividenddata.com, which I'll provide the link in the description below. And that models out the impact of reinvesting dividends. But regardless of that, this simple example still brings up a very important point. Growth is vital if you're planning to invest over the long term. An investment growing at a high rate will begin to dwarf its former self. However, if it's growing at a low rate, 15, 20 years from now, it will still be very similar to how it is today. And over many decades, it becomes very difficult to visualize this level of compounding. However, if you're investing long-term, you need to be aware of this principle. Let me know in the comments if you'd like this simple spreadsheet to be made into a tool available at dividenddata.com. Also, please leave a like and subscribe to our email newsletter so you can get these videos plus a bunch of other great content straight to your inbox. And if you want to use the stock research tool I showed throughout the video, then sign up for our premium tier at dividenddata.com. Links in the description and pinned comment. Thanks for watching.